Rodrigo, nice to see you again.
Hi, Mark. Good to see you.
So let's talk about the Japanese yen, specifically the dollar yen. I want to talk about the long-term trend, the trading range, short-term trading range. Before we get to that, do you have an opinion on the long-term trend in the Japanese yen, or would you be a buyer, would you be a seller, or you don't know?
Yeah, long term, I'm a very high conviction buyer of Japanese yen. Uh, the only reason why the Japanese yen depreciated 50% in the last 3 years was because the Bank of Japan just decided to wait out the inflation storm. Inflation surfaced on the back of some disruption, supply disruption dynamics because of the pandemic. So inflation came to be, and central banks all over the world raised rates to try to tackle that inflation, except the BOJ. In Japan, they said, well, it's transitory. Remember, in the beginning, the Fed was saying, oh, it's transitory. Never mind inflation. It will pass. It's temporary, transitory. Well, the Japanese took the same stance, but only zoomed out much farther. It is transitory. Just wait it out 5 years, and it will pass. Inflation in Japan, it raised up to 4.2% peak inflation, and now, like the rest of the world, is subsiding. The world having supply reestablished. The supply dynamic is in place now. Inflation and rebase effects also of inflation. Inflation is coming down, so they will just wait and see. But the thing, let's be clear that the BOJ is not going to change their policy. They're not going to change the yield curve control YCC. They're going to keep it minus 0.1, and they're just going to be more patient than the rest of the world. That would be Japanese yen weakness, but the rest of the world now is going to lower rates. So that contrast of, say, dollar yen, 5.5 in the US, minus 0.1 in yen, that gap is narrowing and narrowing soon to be. So the US is going to lower rates at the end of this year down to 4.5%, maybe 4 cuts of 25 basis, and then next year down to 2%. So that as that contrast is narrower and narrower, we will see the Japanese yen back at 125, and then to the dollar, and then down to back to where it was before all this, 100. So there are 50 cents to be made there in that trade, provided you have to be patient, and there's the carry costs to be factored in as well. But long term, to answer your question, there's a very good opportunity to be long yen here.
Would you just be buying the currency? Would you be buying assets, Japanese assets, or just the currency?
Yeah, that's a good point. Just the currencies, because if the bonds, it's sideways, right? The bond is priced that if the curve is flat as can be, and it will continue to be. They will do nothing. The BOJ keeps on tempting the market with some speech here and there. There was one recently last night saying, "Oh, we might change our monetary policy," but they won't. So to answer your question, I would be just yen outright, spot yen, because the bonds sideways. There's nothing to see there, and equities. It's a problem all over the world. Equities are stretched at these levels. It's a story of equities, nothing to do specifically with Japan, but it's probably a clear case of buy the rumor, sell the fact. There's a lot of anticipation of equities going up because interest rates are going down. It's beneficial for equities in three fronts. When interest rates go down, of course, it's the same thing. The Nikkei is being benefited by that as well. There's a dynamic all over the world. So I can easily see the case of a classical equities being bought in anticipation of lower rates, but then when lower rates arrive, equities actually fall. So buy the rumor, sell the fact dynamic. People are just taking profits. So then it is the reverse effect. That is a separate discussion. So I wouldn't touch equities now. I wouldn't buy equities at these levels. So Japanese assets, meaning yen, and some hard assets in the country if you have the opportunity. But yeah, the currency is the right. And one of the reasons behind this is important to mention. Japan now at 264% debt to GDP. So
I was
imagine
going
the
to come to that.
Japanese GDP is 4.4.5 trillion dollars. So they have a sovereign debt of $11 trillion. That means every percentage point that they raise rates, if they were to raise rates, is $110 billion in cost of servicing the debt in interest payments. Yes, granted, the Japanese debt is not as scary as it would be because it's internal, it's pension related, it's
Yeah,
the head being too big for the bodies. It's too few young people working and supporting too many
that is the
pensioners.
advantage
And
they have against other countries, isn't it? Because they are the majority holders of their own debt.
yes, they are the majority holders of all that in the world. Even the US now, they even took the baton from China in being the largest holders of US debt. So true, and that's probably why one of the reasons why Japan is still the yen is still a safe haven currency. It's still regarded as a very safe haven currency, and it's probably alongside with the fact that they have the second largest reserves in the world. They have $1.2 trillion in reserves. So that's why the world just ignores and tolerates a 264% of GDP debt ratio.
Nevertheless, we are sliding back towards the lows of the recent decade and a little bit further. We're down to 149 today, slightly down, another 0.5% down.
Yeah,
We're getting towards the lows of 151, I think, 151 and a bit. Um, at what stage would the Bank of Japan start to make the kind of noises that we'd expect from central banks? And what can they do? Because
yeah,
you mentioned the debt ratio, but they have real falling wages, and they have had for 2 years now. That must be a
yeah,
big issue.
yeah. True. On your first point, we're close to that level at 149 as 149.30 as we speak. It's close. The peak was 151.94, so almost 152, but that was end of October 2022. Then we retouched that in November 23, close to that level, and that's the level where they get concerned. 151 they tolerate. Beyond that, it starts to bite too much. Negative real wages. Not just that. On top of that, there's the fact that the global impoverishment of the population, in global terms, if you're a Japanese citizen, the yen doesn't stretch much far now. It's 50% weaker compared to 3 years ago. So it bites. It starts to hurt national pride feeling of purchase power, and it doesn't benefit exports as initially thought as intended. That's a separate topic. But the point being that they start to get concerned around 150,
All right.
and they start, and then
All right.
and we're
All right.
nearly there. And so
So
your second question, what can they do, right?
yeah.
Um, Outright intervention. They have a very beneficial time zone for that. They do things in the middle of the night, which are giantly fat fingers, as it's called in the market jargon, to intervene, just knock out some of the shorts. They have learned the lesson already that it doesn't last much. It just burns some. They have a lot of reserves to burn, but it's inefficient. You do that, and in a few hours later, the market is already piled up on the trade as it was. So it's a very short-lived intervention. Unlikely that they do that. There's a verbal intervention. They can WIDA can come and say, "Well, we're thinking of ditching YCC." The yen appreciates 1-2%, and keeping that lid on 150. But most relevant, it's because it's all this is speculation and market perception. When it starts to get close to 150, again, the market sees that being as a very clear resistance level, and the traders and algos more and more so start taking profit from there. So
All right. All right.
it's a
So
very range bound.
all right. So can I just intervene here?
Yeah.
Back in the heady day when the yen was at dollar yen was 88, I think. I'm not sure
Mhm.
if you remember That's quite a long time
I
ago,
do.
actually.
Yes.
There
Yes. I
was,
actually, I
there was. You were probably a forex trader in those days too. There was
yeah.
concerted intervention by several central banks, and they were very sneaky about it, and it worked, and it had a dramatic effect. It went to 95 or 100 very, very quickly. Now, is there the same impetus for central banks to prevent the yen from going too low?
Yes, but one important, very, very important distinction from those days when the yen was so strong and they intervened. There are two very important distinctions. The first one is that now the market is much more liquid. It's a much more ubiquitous. The trading is much more diverse. There's a lot of algorithmic trading. So it takes a lot more capital to burn to do some sustainable, cause some sustainable impact in intervening. And also, it's much easier to intervene when your currency is being too strong. You just print more, and there is limitless power for that. When it's being too weak, and you want to defend on that side, you have to burn reserves. They have a lot of reserves to burn, but it's not in their interest to be just throwing money out the window for that, especially if it's not efficient like this. So every intervention, I think, is ruled out. What they can do and what they probably do is a verbal intervention when it gets close to 150, telling the market directly or obliquely, saying in a diagonal way, saying, we're not going to tolerate it beyond 150, 151. That's it. And then the market will be very opportunistic and very keen on shorting the pair, just buying yen
Okay,
outright
all
from
right.
those levels. Yeah.
All right. So the other major point that I think is quite interesting here is the carry trade. I believe that
Mm-hmm.
that's still a big deal in in the markets. It seems like a no-brainer, and
It is.
markets have been so happy about this for 2 decades or so now.
Yeah.
What could the effect of, for instance, an event in the world, a global event, what could be the effect on the carry trade and therefore the yen?
That's a very good question because carry trade is still very much in play with the yen being the global funding currency now at these levels, right? Because if you can allocate in government bonds in EU, UK, and US at 4 or 5% per annum, and borrowing in yen is a no-brainer. Borrowing in at zero, if you do it just right, you can borrow in yen at negative rates. So the carry is there, and that's the global funding currency. The very dangerous and interesting consequence of this is that when there is a global event, if there is a massive risk event, like it happened with the pandemic, for example, what happens with the global funding currency is that it appreciates significantly as funds around the world are divesting from their assets. Let's say a hedge fund, wherever, borrowed in yen to buy South African equities. When the risk clear scenario is there, when the storm is coming, what happens is they will sell those equities in South Africa, for example, wherever. And then what do? They have to repay the loan in yen. So they buy yen. At these levels, at 150-ish, there's a lot of room for a massive, massive move in appreciation of yen if a risk scenario bites. And add to that the fact that the yen is a safe haven currency still. If there is, let's say, a broad war in the Middle East, or if something happens with the Russia-Ukraine war, or if Donald Trump is assassinated, like a very crazy scenario of risk could shake the world, the yen, the room for appreciation in yen is massive. So that scenario of yen appreciating down to 125 or 100 to the dollar is brought forward because there's a lot of borrowed money to be reversed back to yen.
Okay, Rodrigo. Well, thank you very much for that. That's all we've got time for today, but I look forward to speaking to you in the next few days. Thank you. Bye bye.
Look forward. Bye.